Hi, Andrew here again. As we become more intentional about our buying decisions and reducing the consumption of things that are have a negative impact on the planet, or we're more conscious about recycling or reducing consumption generally, people have now been more considerate, giving more attention to actually how their money might be invested. So the purpose of this video is to explain two different options available to you when you're thinking about how your money is invested and being more conscious about the impact it's having on the world and society. So the first one, which has got a lot more media attention over the past year or so, is ESG investing, and that stands for environmental, social and governance. And it's for any investor who really wants to make sure they're not part of a problem, i.e. they want to reduce their carbon footprint, or they don't want to invest in companies that have inequality in the workplace, particularly at director and board level, or there's questions around executive pay and the vast sums that executive might be paying themselves relative to what they're paying for their staff. So with ESG, portfolios in which you're invested are being selective on those parameters. Now, it's very hard to be entirely exclusive in one or the other. It's a very grey area. For example, companies like Google might be doing a lot to have a diverse workforce, but we know the issues that they've had around use of our data and data privacy. Impact investing, on the other hand, is for investors who want to be part of the solution and want to be more decisive in the companies that they choose to invest in or not invest in. And so these are the types of companies that are looking to provide solutions to the world's problems, and often invested in portfolios that align to the UN global agreements that came from the Paris Accord particularly. I liken it to a doorman policy, where if you think about a queue forming to get into a nightclub, the doorman will not let in anyone who is drunk or look like they've taken something they shouldn't and is going to become a menace and a nuisance to those inside. They'll get immediately excluded. Now, there might be some people queuing up who are only there for a good time and going to be a lot of fun to be with, and will be add to the environment and the atmosphere within the club, and they'll get welcomed straight in. And there's the middle ground, the people who might have had a little bit to drink, might be slightly on the edge, but the doorman, the bouncer at the entrance to the nightclub is prepared to take a risk and say, well, you're going to have a net positive benefit to the club, so you can come in, but we're going to keep an eye on you. If you mess about or cause disruption, you're going to get chucked out again. And that's how these impact portfolios generally work. There'll be those companies that are immediately excluded. There will be the tobacco manufacturers, the gambling companies, adult entertainment, those with huge carbon emissions, the oil extraction companies, they'll immediately excluded from a portfolio. Those where there will be an overall positive impact are those that are looking for solutions to climate change or other environmental factors, or doing a lot around stakeholder engagement and doing a lot for their communities and their workforce. And those that might be on the edge, a good example might be the water companies that are doing a lot to improve water quality. But as we know at the minute, there's a lot of issues around, particularly in the UK, water companies pumping sewage out into the rivers and the oceans, and also issues around executive pay. So investment companies will be keeping an eye on them and say, well, if you're not improving on these topics, then you're going to be excluded from our portfolios. So I hope that explains the key differences. Please do let me know if you've got any questions about it.